Right now, as you are watching this, silver is trading at $82 and change. And if you think that number means nothing, you are about to be proven very, very wrong. Because what happened in the last 5 days is not a bounce. It is not a relief rally. It is not traders buying the dip, hoping for a quick flip. It is something far more dangerous. And the next 72 hours will decide whether silver explodes past $100 or whether the system finds a way to kill it one more time. Let me be very clear about what I am saying. This is not speculation. This is not a prediction based on charts or sentiment or some analyst's gut feeling. This is math. This is inventory data. This is delivery pressure that has never been seen before in the modern silver market. And the clock is ticking. On January 29th, silver hit $121 per ounce, a record, a price that shocked even the most bullish silver believers. And then, 2 days later, it collapsed. Not slowly, not in an orderly correction. It fell 31% in a single session, from $121 to $78, the worst crash in 44 years. Mainstream media called it a bubble popping. They called it over-leveraged speculators getting wiped out. They called it the end of the silver rally. They were wrong. And the data that just came out in the last 48 hours proves it. Because silver did not stay at $78. It clawed its way back to $83 in 5 days. That is not the behavior of a market that is finished. That is the behavior of a market that is being bought aggressively every single time it dips. And here is what nobody is telling you. The crash did not solve the problem. It did not relieve the delivery pressure. It did not fix the inventory crisis. In fact, it made it worse, because the people who understand what is happening did not sell during the crash. They bought, they took delivery, they drained the vaults. Let me show you the numbers. As of February 5th, COMEX registered silver inventory sits at 103 million ounces. That is the metal available for delivery. The March 2026 contract, which begins delivery in 17 days, has open interest representing 429 million ounces of silver. Do the math. 429 million ounces of demand, 103 million ounces of supply. That is a 4-to-1 ratio. Now, in a normal market, most futures contracts roll forward. Traders close their positions. They take cash settlement. They do not demand physical metal. But this is not a normal market, and February just proved it. Out of 19 million ounces of open interest in the February contract, 18.7 million were delivered. That is a 98% delivery rate. 98%. In a market where 5 to 10% is considered normal. This is not a futures market anymore. This is a physical allocation system. And the COMEX is running out of metal. Fast. Every single day, 785,000 ounces leave the registered vaults. If that rate continues, by the time March delivery starts on February 27th, there will be 85 million ounces left. Maybe less. And if even 25% of March open interest demands delivery, that is over 100 million ounces. The math does not work. So what happens when the exchange does not have enough metal to deliver? There are only two options, force majeure or cash settlement. Either way, the moment COMEX fails to deliver physical silver, the paper price becomes meaningless. The real price will be set somewhere else. Shanghai, Hong Kong. The physical markets where buyers are already paying premiums of 10 to 15% over COMEX spot prices. And that brings us to the next 72 hours. Because right now, silver is sitting at a critical level. It is holding above $80. If it breaks and holds above 85 in the next 3 days, the technical breakout is confirmed. Momentum algorithms start buying, short covering accelerates. But if the banks can push it back below 80, if they can trigger another wave of panic selling, they buy themselves time, maybe a few more weeks. The question is whether they still have the firepower to do it, because the January crash was their best shot. They hit silver with everything they had, margin hikes, algorithmic selling, coordinated dumps of paper contracts, and it worked for 48 hours. Then the buyers came back, and those buyers are not retail traders chasing momentum. They are industrial users who need physical metal. They are Asian funds securing strategic reserves. They are investors who understand that the paper market is breaking, and they are converting contracts into bars before the system runs out. Here is what changed in the last 72 hours that makes this moment different from every other dip in the past 5 years. Number one, the delivery rate in February hit 98%. That has never happened before. Not in 2020, not in 2011, not even in 1980. Number two, registered inventory is draining faster than it did during the January squeeze. We are losing almost 800,000 ounces per day. Number three, open interest in March is not rolling forward. Traders are not extending their positions. They are pulling delivery dates backward. What does that mean? It means people do not want to wait until March to get their silver. They are demanding it now. In January. In February. That is front-running behavior. That is what happens when market participants believe there will not be enough metal to go around when March arrives. And number 4, the Shanghai premium is back above 10%. Chinese buyers are paying $92 per ounce for physical delivery right now, while COMEX is quoting 82. That $12 spread is not noise, that is arbitrage. That is a signal that physical silver is worth more than paper silver. So here is where we are. The crash happened, the weak hands sold, the leveraged positions got liquidated, and silver is right back where it was before the crash started. Except now the inventory is lower, the delivery pressure is higher, and the March contract is 17 days away from its first notice day. The next 72 hours will tell us whether the banks can suppress this one more time, or whether the physical market finally breaks free from the paper price. If you found this breakdown valuable, do me a favor. Hit that like button right now. It helps the algorithm push this to more people who need to see it. And drop a comment below. Tell me where you're watching this from. Because this story affects every market, every currency, every portfolio on the planet. There's one name that keeps appearing in every single delivery report. One institution that closed a massive short position at exactly $78. The same institution that paid $920 million in fines for manipulating precious metals markets. JP Morgan. Let me show you what they just did, because it explains everything about why silver crashed to 78 and why it bounced back to 83 so fast. In December, analysts estimated JP Morgan held somewhere between 500 and 750 million ounces of physical silver, the largest stockpile in history. At the same time, they were short 200 million ounces in paper contracts on COMEX, a hedge position that made sense when silver was at $40 or $50. But when silver hit 121 on January 29th, that short position became a nightmare, a liability that grew larger every single day the price climbed. So what did they do? They engineered the crash, not alone, not openly, but through mechanisms that are perfectly legal and completely devastating to anyone holding leverage. On January 31st, 3 things happened within hours of each other. CME raised margin requirements on silver futures by 47% in one session. Reuters published a false report claiming the U.S. government was stepping back from critical mineral price guarantees. The Department of Energy later called it misleading. And the London Metal Exchange experienced a technical glitch that took the entire silver market offline for 90 minutes during peak Asian trading hours. Coincidence? Maybe, but the result was undeniable. Algorithmic selling cascaded across every exchange. Stop losses triggered in waves. Leveraged longs got liquidated, and silver fell from $121 to $78 in less than 24 hours. A 35% crash, the worst since 1980. COMEX delivery data shows JP Morgan covered 633 contracts at an average price of $78.29, exactly at the bottom of the crash. They closed their entire short position, 200 million ounces of paper exposure, gone, at the exact moment when silver hit its lowest price in weeks. That is not luck. That is precision. That is knowing exactly when the selling pressure will peak and having the capital to execute at scale. But here is what makes this different from every other manipulation story you have heard. JP Morgan did not stay short. They flipped long. They are now net buyers of physical silver, standing for delivery on COMEX contracts, draining registered inventory, taking metal out of the system. Why? Because they know what is coming. They know the March contract is going to be a disaster. They know the vaults do not have enough metal, and they are positioning themselves on the right side of the trade before the system breaks. That is the signal. That is the confirmation. When the largest silver shorter in history closes their position and flips bullish, it means the game has changed. The rules no longer work. Now let me show you what happened to the vaults during the crash, because this is where the story gets even more interesting. Between January 31st and February 5th, registered silver inventory at COMEX fell by 2.3 million ounces. That is during a 35% price crash. Think about that. The price collapsed. Panic selling dominated the headlines, and physical metal continued to leave the vaults, not slowly, aggressively. Who was buying during the crash? Industrial users, Asian funds, sovereign wealth entities. Anyone who understands that $78 for physical silver is a gift, because the paper price might have been $78, but the physical premium in Shanghai was $92. In Dubai, it was $87. In Tokyo, it was $89. The global physical market never believed the crash was real. They kept buying, they kept draining inventory, they kept taking delivery. And that is why silver bounced back to 83 in 5 days. Because the crash was a paper event, a margin-induced liquidation, not a fundamental repricing. The physical market did not participate in the sell-off. It absorbed it. And now the paper price is catching up to reality. Here is the critical piece that almost everyone is missing. The February contract just finished delivering 98% delivery rate, unprecedented. That means the people who held February contracts did not roll them forward. They did not take cash. They demanded the metal, and they got it. But those deliveries drained registered inventory to 103 million ounces. the lowest level since 2020. And March is next. March has open interest representing 429 million ounces. If even 20% demands delivery, that is 86 million ounces. COMEX does not have 86 million ounces available, not even close, which means something has to give. Either the price spikes to discourage delivery, or the exchange implements emergency measures, cash settlement, delivery delays, force majeure, all of which would destroy confidence in the paper market. This is not speculation. This is arithmetic. The numbers do not lie, and the next 17 days will prove whether COMEX can survive March delivery. Now, let me tie this back to the 72-hour window we are in right now, because the technical picture just flipped. Silver is holding above $80. It tested 79 twice in the last 48 hours. Both times it bounced hard. Buyers stepped in immediately. That is a floor. That is support. That is the level where physical demand overwhelms paper selling. And once a floor is established, the next move is higher. If silver breaks 85 in the next 3 days, the momentum algorithms activate. Short covering accelerates. Retail FOMO starts building. And the race toward 100 begins. Not gradually, explosively, because everyone who sold at 78 is now underwater at 83. They are watching the price climb back. They are calculating their losses. And at some point, they panic and cover. That is the squeeze. That is what happens when physical demand creates a floor under a market that was artificially crashed by paper selling. The next 72 hours will decide whether 83 holds, whether 85 breaks, whether March delivery becomes the crisis everyone is preparing for, and whether JP Morgan's flip from short to long was the smartest trade of the decade or just the beginning of something much larger. On January 1st, something changed that most people still do not understand. China flipped the switch, and the global silver market will never be the same. China implemented export licensing controls on refined silver. Not a ban, not a complete cutoff, but something far more calculated, far more strategic. Starting this year, only 44 companies are authorized to export silver from China. 44. Out of hundreds that used to ship metal freely to the West. To qualify, a company must produce at least 80 tons of silver annually. They must have a $30 million credit line. They must be state approved. That eliminated every small and mid-sized refiner overnight. The companies that used to supply India, Europe, North America, gone from the export market. China controls between 60 and 70% of the world's refined silver supply. Not mined silver, refined silver. The metal that is actually usable. And now Beijing decides who gets access to it. When they get it, how much they get. That is not a free market. That is a choke point. That is leverage. Why did they do this? Because China needs silver, desperately. Their solar panel production consumes more silver than any industry on Earth. Every electric vehicle manufactured in China requires silver. Every 5G tower, every data center, every advanced semiconductor. Silver is everywhere, and China is not exporting a critical resource when they need it domestically. So they cut off the West, quietly, legally, permanently. Elon Musk called it out publicly on X. He said this is not good. Silver is needed in many industrial processes. That was his exact quote. When the CEO of Tesla, a company that needs silver for every vehicle they produce, is warning about supply constraints, that is a signal. The Shanghai Gold Exchange reported physical silver stocks at 10-year lows in December. 10 years. They are draining their own vaults to meet domestic demand. And at the same time, they are blocking exports, which means every ounce of silver that leaves China now comes at a premium, a massive premium. In early January, the COMEX March contract was trading at $72. Physical silver in Dubai was selling for $100 per ounce. That is a $28 premium. Not $2, not $5, $28. That is not a normal market spread. That is a broken pricing mechanism. When the paper price in New York is 72 and the physical price in the Middle East is 100, it tells you the paper market is lying. It tells you the real value of silver is being discovered somewhere else, in markets where people pay cash and take delivery, not trade contracts. And here's the part that connects directly to COMEX and the March delivery crisis. China's export controls went live on January 1st. That means every industrial buyer who was counting on Chinese silver to meet production schedules just got cut off or severely restricted. So where do they go? COMEX? They go to New York. They demand delivery on futures contracts. They convert paper into physical. They drain the vaults. That is why registered inventory fell to 103 million ounces. That is why the February delivery rate hit 98%. Industrial users are not waiting anymore. They are not rolling contracts. They are taking metal now because they do not know if it will be available later. And the March contract is sitting there with 429 million ounces of open interest. 17 days until first notice day. If China's export controls force just 10% more industrial demand into COMEX delivery, that is an additional 43 million ounces. COMEX does not have 43 million extra ounces. They barely have 103 million total. The math is breaking in real time. This is not a temporary supply issue. This is not a logistics problem that gets solved in a few weeks. This is structural. This is permanent. China is not reversing these controls. They are expanding them. This is the same playbook they used with rare earth elements, with tungsten, with antimony. Control the supply, prioritize domestic use, weaponize access, and watch the West scramble to figure out how to function without it. Silver just became a geopolitical asset. It is not just a commodity anymore. It is leverage. It is a strategic resource. It is a choke point in the supply chain. And the price has not caught up yet. Because most traders still think this is about charts and momentum and technical levels. They do not understand that the entire supply structure of the global silver market just got rewritten. And the consequences are only beginning to show up. The next 72 hours will reveal whether Western markets can absorb this reality, or whether the paper price finally surrenders to the physical shortage. February 27th is first notice day for March delivery. That is 16 days from today. In 16 days, we find out if COMEX can survive this crisis. First notice day is when contract holders send notice to the exchange requesting physical delivery. The exchange matches notices with inventory and bars leave vaults. But what happens when notices exceed available inventory? That has never happened in COMEX history, not even during the Hunt brothers squeeze back in 1980. The exchange has three options. Force majeure declaring unforeseen circumstances prevent delivery. Cash settlement paying dollar value instead of metal delivery. Or emergency rule changes implementing delivery delays preventing contract holders from demanding physical. All three options destroy confidence in the paper market permanently. Because the moment COMEX fails to deliver silver on a contract where delivery was promised, the paper price becomes meaningless. Real price gets discovered somewhere else. Shanghai already trades at premiums of $10 to $12 per ounce over COMEX spot. Dubai pays similar premiums for physical delivery with no delays at all. That spread tells you physical silver is worth more than paper silver. The market split into two tiers. One tier trades contracts, other tier trades actual bars. March contract forces everyone to choose which tier they believe in. Contracts can be cash settled. Bars cannot be printed when they do not exist at all. 429 million ounces of open interest. 103 million ounces of registered inventory. If 20% demands delivery, COMEX lacks the metal. February contract just proved 98% of participants demanded delivery. Not 5%. 98% converted paper into physical bars yesterday. If March follows the same pattern, COMEX needs 420 million ounces. They have 103 million available. That is a 317 million shortfall. No warehouse on Earth can provide that much silver in 16 days. The physical metal does not exist anywhere. Either price spikes to discourage delivery or system breaks. In my view, we are watching the end of the paper-silver market as it operated for 50 years. The futures exchange was never designed for this delivery level. It was designed for price discovery and hedging. Miners hedge production, users hedge consumption. Most contracts settle in cash without delivery, but 98% change that. When 98% demand physical metal, the system breaks down. The exchange does not hold enough inventory to back every outstanding contract simultaneously at all. This is fractional reserve banking applied to commodities. It works until everyone demands their metal at once. When they do, the system collapses instantly and completely. China's export controls that began January 1st accelerated this crisis. Industrial users who relied on Chinese silver now source metal from COMEX or pay massive premiums. So they convert futures into physical delivery. They drain registered inventory. They take metal out before someone else takes it first, and nothing remains for later buyers. That is panic buying disguised as normal market activity. Panic buying does not stop until either price becomes prohibitively expensive or supply runs out completely. Silver sits at $83 today. It crashed to $78 and bounced back in 5 days. The crash did not solve the problem. It proved buyers wanted more metal. JP Morgan covered their entire short position at $78. They closed 200 million ounces of paper exposure at the exact bottom. That is not luck at all. And then they flipped long. They are now standing for delivery. They are draining inventory. They are positioning on the right side before the system breaks down entirely. When the largest silver shorter in history closes their position and buys physical metal, that is the signal. That confirms the rules changed and paper markets lost control. JP Morgan is not buying physical silver because they think price goes up 5%. They are buying because they know March delivery will be an absolute disaster, and they want to own the metal before COMEX runs out of metal to deliver. That is strategic positioning. That is what insiders do when they know what is coming next. So here's where we are today, February 10th, 16 days before first notice day. Silver holds above 80. Inventory falls. Delivery pressure builds daily without stopping. The next 72 hours determine whether 85 breaks and momentum accelerates. But the next 16 days determine whether COMEX silver market survives March delivery. If you found this valuable, hit that like button right now. Drop a comment below. Tell me if COMEX survives March delivery or if everything changes forever. What happens in the next 16 days affects every commodity market, every futures exchange, every paper contract, promising physical delivery it cannot provide. This is the test. This is when we find out if paper promises survive, when everyone demands the physical asset simultaneously without waiting any longer at all. March 27th is coming. The clock is ticking. The math does not lie. We witness history soon. The only question is which side of history you choose to be on today.